Hi, welcome to Market in a Minute. So it was an exciting weekend, wasn't it? So, how to play the conflict in the Middle East? We've got a great idea. Well, I want to walk you through that. Inflation, technology valuations, technology fundamentals, credit risk, high valuations in general, i.e., volatility. So, our point is, be opportunistic. Keep a little dry powder. Maybe have some hedges in your portfolio, but there's opportunities coming. We can see this market go up significantly higher if we see inflation come down and oil prices drop. We got a compelling comparison, IMRX versus RVMD. Did the Oppenheimer conference last week, saw tons of companies, right? This is the one that really stands out, IMRX. So disclosures, please read this. The Middle East. So this is playing out more or less as we expected. So with age, you've seen a couple of these, right? You kind of know what to expect. The markets generally discount what the conflict or the war before it actually happens, and then when the war starts, it rallies. This time was a little different. So the market internals were pretty negative. So we saw an internal correction in the overall markets before it happened. Oil prices did their thing, right? When the oil prices have gone up roughly 18% through Friday. If you include Monday, they're up nearly 25% year to date. So oil prices is up quite a bit. So some of the research we were getting was saying, okay, Thursday would be the day that the conflict would start. We were thinking Friday, came Saturday. Our point is the market was already anticipating this. You have to be half dead not to realize that the war was coming. So energy stocks went up on Monday. Defense stocks went up. The market held in there pretty well. Actually, held in there pretty darn strong. The Strait of Hormuz is the key. So Iran cannot, close the Strait of Hormuz. They could make it dangerous for a period of time, but that's going to end. The important part about this is that 20% of the supply of oil globally has to go through this narrow strait. So if the narrow strait actually gets closed for an extended period of time, it's going to cause oil prices to continue to go up, and that won't be good. So what really surprised us with this conflict so far is Iran firing at their neighbors. I think that's a big mistake. So they fired at the natural gas facility in Qatar. Qatar supplies about 5% of the world's natural gas. So that's not a huge deal, but it's important. And I think that could be filled by probably the United States or somewhere else. But that's a fair amount of supply, so it impacted natural gas as well. So what's happening next? We think it's going to take probably longer maybe than expected to change the leadership in Iran. But we think it ultimately happens. And the bottom line is this high elevated price will come down. This is going to be a really nice event when it comes down. So oil is going to come back down in price. Maybe it comes back down to the high 50s again. So that kind of takes away a lot of the risk out there in the overall markets if that occurs. We think that Iran will be cut off for a period of time until our government, Trump, is satisfied with whoever's taken over the government. So that's another risk to think about. So Iran cut off for a period of time, 2% of the supply. Okay, OPEC or Saudi Arabia can pick up that excess demand issue or supply issue. Supply is being cut off. So in general, we think that this is turning into an opportunity rather than being a negative. As oil prices come back down, it really helps the inflation story. So the stock market. We think the stock market issues are the same. We had this conflict, well advertised. Hopefully nothing serious comes out with it besides the higher energy prices lasting maybe 2-3 weeks or maybe longer. When oil prices come back down, the inflation is going to come back down. So right now, the market's kind of stuck with these higher oil prices. Inflation probably cannot come down without those oil prices coming back down. So a little bit, this rotation trade is stuck. Maybe the technology trade looks a little bit better to the markets right now, but in general, we think that the markets are kind of in this pause mode, and then it'll turn positive. So the tech stocks have been a concern for the overall markets. It's been overplayed. Too much money's moved into that area of the markets. Now I think about this: is Nvidia's moat, is it starting to see some cracks in it? We think so. So what we mean is that Google and Amazon, they have their own chips. Broadcom is there. They're making chips as well. Marvell. So we think all these guys kind of, AMD, you forgot those guys, right? So we think all these guys working, you know, are trying to get after that market share. And they will. They'll take some of that away. So NVIDIA being the largest stock in the tech group and largest stock in the overall stock market is vulnerable. Now, we don't think it's going to fall apart overnight, but that's why there's a big pause on tech and all that spending that has occurred in technology. It's getting to a point of being too large. So some of the stocks that we like in the tech space, Marvell, you can play that off of what's going on at Amazon. Um, ServiceNow, we think that's a quality software company. Salesforce, this was crazy. Last week, they said they're going to buy about $50 billion worth of stock. They don't have $50 billion, but they could over time. So that just tells you the frustration that companies has and the positive things that they're seeing. Amazon, we like Amazon a lot for a number of reasons, and we've illuminated those in the past. Uber, I think this is a good way to play autonomous driving. And then Anthropic, private company. We think they picked a fight with the wrong guy. So, the government's just taking them off. And OpenAI, man, they're being opportunistic, kind of like how we like to manage money. See the opportunity and go for it. Congratulations to OpenAI getting that business. Credit concerns. Okay, these concerns are running through the markets. There's a little bit of credit issues, not much. Some of the guys have had credit issues for a while. Some of those players continue to have credit issues. They're not going away, but we don't see anything really happening. There's no credit issues really mounting that's of any concern that we see. So the loan losses aren't going up at this point. This has been an issue for the stock market, not the bond market. So if you have credit issues, it's going to show up in the bond market, right? So we're not seeing that spread between the low quality bonds and the higher quality bonds expand out. So that's not happened at this point. It's a stock market issue. It's the retail investors that can't get out of some of these private credit securities that they're in. So this has nothing to do with credit itself. And I think some of the comments have been made lately just completely missed the point, which has created some opportunities. So we covered this last week. OTF, it's one of our favorites. Runway, RWY, another BDC. We like that one as well. Both of those are trading so far below their NAVs. They have big upside potential. And then Capital One, I think this is a mispriced stock. It's on a secular basis. It's really changing nicely and probably will have a big move over the next several years. Volatility. We think that the markets will continue to have volatility. And if we can't see into 2027 and see a good picture there, can't see inflation coming down, then the markets are not going to like that. The markets could correct quite a bit this year. But I think ultimately the inflation issues go away and we see into 2027 is likely to be nicely positive with all the stimulus that the government has been doing. So the Druckenmiller scenario, we think Druckenmiller is one of the geniuses in our business. So when he speaks, we listen. So what he's looking for is not happening yet. Doesn't mean it won't, but it's not happening. The 10-year Treasury yield's not going up. Actually, it's coming down. It's come down a little bit. Regional banks, they're not breaking. A little bit of they've pulled back a little bit. The bank groups pulled back a little bit, but nothing significant. It's just market related. And the spreads, as I mentioned before, the spreads on low quality bonds not moving yet. So not seeing those signs of that scenario playing out, where we have a big liquidity issues in the overall markets. So the thing to watch is the technicals. Those will lead us to the answer before we see it in the fundamentals. So our goal is to remain fairly, conservative. Keep some dry powder. We've got some hedges in the portfolio, meaning some inverses. As the markets give us opportunity, then we'll take advantage of it. Now the technicals. So this has been so irritating, right? The S&P 500 stuck in this tight range, 6,800 to almost 7,000, stuck in this range for 3+ months now. It's broken the 50-day moving average 6 different times. So generally when it breaks the 50-day, we get very nervous about what's going on and look for a correction to occur. It's done it 6 different times, so I feel like Charlie Brown trying to kick the football a little bit. But we're not seeing the breakdown, and so no reason to get too excited at this point. If not for the rotation in the markets, we think that the stock market would be down roughly 10% looking at what's happening in the tech group. Some of those tech stocks have pulled back in a massive way. So without the big rotation, the markets would probably be down nicely. We've got the rotation. Hopefully it holds in there and can wait long enough for the inflation numbers to come down and really fuel this market as we look out to 2027. So if we see 2027 look reasonably good and we hold in this range, so the longer we hold in this range, the more positive it is for the overall stock market to probably move up. Biotech. As I mentioned, we did the biotechnology conference with Oppenheimer last week, saw tons of companies over 2 days. I tell you, that's tiring, but really enjoyable. So saw a lot of really interesting companies, some we knew, some we didn't. And in biotechnology, you always see companies you don't know. There's so many of them, 700 different companies in that emerging healthcare area of the overall markets. That's a lot, 700 different companies. So it's inefficient. This is an inefficient market, which I love. I love inefficiency. So it gives us time to do the research, gives us time to build a position. It's not like tech where it all moves in a day. So it gives you that opportunity to really understand what's going on in a company and establish that position. So I had a meeting with the CEO of Immuneering, IMRX, and it was a very good meeting. Discussed their pancreatic cancer drug, which is they wrapped up phase 2 and they're entering phase 3. They will enter phase 3 this year, and the data looks great. So he did for me, and my big question was compare Evolution Medicine's drug, RevMed, RVMD, compare their drug with your drug. And obviously there's no bias involved in this, right? So he did it. And he made some compelling points, and darn if it doesn't look like they may have the better drug, a better way of also administering the drug, which I thought was really smart on their part on how cancer works. The market cap on RevMed, it's $19.6 billion, okay? IMRX is $320 million, yeah, with an M, million. So 19.6 billion versus 320 million. Granted, RevMed, they're ahead in terms of time frame, maybe as much as 2 years ahead. So the two, it doesn't equate. So either RevMed has to be a lot lower, or IMRX has to be a lot higher. So if IMRX will get the same valuation of RevMed, say 2 years out, that's a 60 times return, okay? I think that's a risk worth taking. It is for me. So you do your own homework. and you can decide for yourself. Go to the IMRX's website, and there's a slide on there that compares the two drugs. So if you have any questions, please come to my website, Patrick Adams CFA. Ping me off the video. Come to PVG, look at the strategies we manage. I'm a loss averse investor. I hate to lose money, but I also love making money as well. So we have opportunities. By God, we're going to go for them. So we're looking for some opportunistic purchasing as the market sorts all this out, and as inflation comes down and we look out to 2027, we think we're going to have a big move in front of us. But keep in mind we're still looking for volatility. Take care.